Welcome to Acera's new employee slash mid-career seminar. Excuse me. In this seminar, we are assuming that you're either new or you're somewhere in your mid-career, hence the name of the seminar. So you are not near retirement yet. And that is a good thing because it means you still have plenty of time to plan for your retirement. So in this seminar, I'm going to tell you all the things that you might want to know about doing that planning. And since you are curious enough about retirement planning to watch this, you probably have some questions. Questions like, what do I need to know about my pension? Do I need to do anything at this point? And if so, what might I need to do? So I'm going to answer all of those questions for you. And I have organized the seminar into the form of this checklist. First, I'm going to help you understand some retirement basics. I'm also going to help you understand pension math because that'll help you understand the benefits that you're earning a little bit better. We'll talk a little bit about the retirement formula that we use to calculate your retirement benefits, and I'll tell you about purchasing service credit to increase your retirement benefit. I'm going to show you how to get a pension estimate. I'm going to help you understand retirement eligibility. I'm going to help you understand some additional benefits that we have above the retirement allowance that you will see when you retire. I'll talk to you about designating your beneficiary or beneficiaries for death benefits. I'll help you understand some career planning options, and we'll talk about making a retirement planning picture. We'll also talk about starting a 457B account, and we'll have a presentation from the county's 457B program regarding 457B accounts. And then I'll talk a little bit about signing up for Acera News. Let's jump right in. First off, let me help you understand some retirement basics. If I can get the slide to advance. Okay, so who is Acera? Acera is the Alameda County Employees Retirement Association. It's made up of a lot of people. There's about 90 of us that work at Acera, and what we do is we provide retirement, disability, and death benefits to our members. That is you. You are our members. You're a member of Acera because of the position that you work in and who you work for. Okay, so you work, or at some point you worked full-time, and that full-time was in or is in a retirement eligible position. Okay, and that position is working for one of the 6 employers that participates in Acera. These are the county agencies that that kind of sorry, I'm losing my verb here, that get with Acera, I'll just go with get, to provide their employees with retirement benefits. So you're earning benefits as you work in these positions. Okay, as an Acera member, you pay into Acera's fund. So every time you get paid, you'll see a little line in your paycheck. In fact, I have a screenshot of an example of that right here. This is an example of an employee pay stub. You'll see a line in the before tax deductions column coming out of your check and going into Acera's fund. Your employer also makes contributions similarly on your behalf. So then we don't want that money to just sit around. We invest it all over the world and we earn a lot of interest on that money. And these 3 sources of income, your contributions, your employer's contributions, and the investment earnings are what gives us this big pot of money that we call Acera's fund. Okay, so then what do we do with that money? So meanwhile, you are earning credit toward retirement as you work. So as you work, you earn credit toward retirement. And then at some point in the future, you're going to retire from Acera and from your job. And at that point, that's when you start collecting that monthly retirement allowance for life that you've been earning throughout your working career. Okay, you'll notice it says for life. It's going to be every month on the last business day of the month for the rest of your life. So you cannot outlive your retirement. It just continues on until your death. It's a really beautiful thing. In fact, pensions are special in this way because you cannot outlive your retirement. Another reason why pensions are special is because all of those employee contributions that you paid in to Acera throughout your entire career, we're going to pay all of that money back to you within your first 3 to 5 years of retirement. So then maybe you live another 10, 20, 30 years. after your retirement. Hopefully, it's a really long retirement and you have a really long lifespan. You're still going to collect your retirement that you earned for the rest of your life. So everything after the first 3 to 5 years is just like a major bonus for you. And really, it's not so much of a bonus, it's a benefit that you earn and it's a benefit that you can count on. And that was part of the deal that you signed up for in your public position, that you're earning a retirement that you will be able to count on for the rest of your life. Okay, let me show you this pension milestone chart. These are some of the milestones that you will see with your membership in Acera. Okay, so first off, we have your date of hire. This is your first day that they told you to show up to work, or if you didn't start out in your full-time retirement eligible position, this would be your first day working in that full-time retirement eligible position. Okay, then for almost everyone, 2 weeks goes by. And the first day of your second pay period, that is your first day of Acera membership, and that's when you start earning credit toward retirement. Now, for a couple of our employers, I believe it is the Housing Authority and Livermore Area Recreation and Parks District. I think your date of entry into Acera is actually on that first day in that retirement eligible position. You should check our website to verify that on the pension milestone page. Okay, so now that you're a member of Acera, you've entered Acera, you've started earning credit toward retirement. Next thing that happens is 5 years goes by. Once you work full-time for 5 years, or the equivalent of full-time for 5 years, you are considered vested in the retirement system. And vested, you may have heard that word, that just means guaranteed. So when you're vested, you're guaranteed the guaranteed benefits. You're guaranteed the vested benefits. Okay. And so it's not really any more complicated than that. Okay, then at some point after you become vested, and it's going to be different for everyone, you become eligible to retire. And it's going to be some combination of your years of service credit and your age that will get you to that retirement eligibility. And I'll talk about that later in the presentation. So once you're eligible to retire, you can retire on that day, or you can keep working and keep earning more credit toward retirement. And then at some point in the future, there will be a retirement date that you choose. And that will be your day that you stop earning retirement and start collecting your retirement. And you're going to collect that retirement, like I said, every month for the rest of your life. So your death is when your retirement payment stops. Okay, now there's another pension milestone on here. For many of the options that you will select at the time of retirement, there can be a continuing payment to a beneficiary after your death. And usually it's for the rest of the beneficiary's life. So at their death, those beneficiary payments would stop. Okay. One more thing about vesting, like I said, it happens with 5 years of service credit. That includes reciprocal service credit. And I'll talk about reciprocity in the second half of the presentation, but it's essentially when you're linking other California public retirement systems together. All of the years that you worked in all of those linked systems will get you over that 5-year mark for you to be considered vested in all the systems. If you don't have any other systems linked together, it's just 5 full-time years of service credit. And the guarantee in the vesting, like I said, vesting means guaranteed. That is guaranteed by state law, the 1937 Act. And the vested benefits are the monthly retirement allowance for the rest of your life. So I'll call it monthly retirement allowance, monthly retirement benefit, retirement allowance. It's all different synonyms for the same thing. Another vested benefit is an annual cost of living increase to your retirement allowance. And another vested benefit, the third vested benefit, is a $1,000 lump sum death benefit. It doesn't sound like much, but there are other death benefits associated with the different retirement options that you will select at the time of retirement. Okay, so I'm getting a comment, not sure if it's my computer, but I can see you. I don't hear you. Let me check the sound here because I'm actually signed in. I'll type my answer. I can hear me as a participant. So I think it's your computer. Okay. So let me talk to you about your tier. You all are in one of these tiers. Okay. And your tier is based on your date of entry into Acera. So going back to the pension milestone chart, it's based on this day right here, your date of entry into Acera. And if you fall in a certain date range, that puts you in a certain tier. Okay, so to find which one of these date range timelines you're going to be looking at, first of all, safety members are going to look at the bottom. Now, safety members are sheriff's deputies and probation officers, and there may be some other sworn officers in there. So if you're not a safety member, you're a general member. So general member is everyone who's not a safety member. Okay, general members, you're going to look at this top timeline. Unless you're a general member who works for the Housing Authority or a general member who works for Livermore Area Recreation and Parks District, and then you look at your appropriate timeline here. Okay, now the way the timelines work is if your Acera date of entry is before the cutoff date for each tier, that puts you in the earlier tier. So if you entered Acera before July 1st, 1983, that puts you in tier 1 as a general member. If you entered Acera July 1st, 1983, all the way up to December 31st, 2012, that puts you in tier 2. If you entered Acera January 1st, 2013 and beyond, for all of the timelines, that puts you in tier 4. Okay. Now you can see that the Housing Authority has a different cutoff for tier 1. LARPD has a different tier, tier 3. And the safety members have multiple tier 2s. For the safety members, if you entered Acera between October 17th, 2010 and December 31st, 2012, you're either in tier 2C or tier 2D, and you made that selection at the time that you entered your safety membership. So if you want to double check which one you're in, you can log into your account on our website, and it will tell you which tier you're in. And that goes for everyone. If you want to double check which tier you're in, log into your account on our website. Okay. So let me show you this slide right here. This is kind of a preview of what we're going to talk about in the last portion of the presentation. This says retirement income to maintain your standard of living. Okay, so these are 3 sources of income that you will see as a retiree, that you will likely see as a retiree. So when you go to retire and you're not earning your paycheck anymore from your employer, you're going to need to pay for your life somehow. And so you will have that Acera monthly pension will pay for part of it. Your Social Security that the federal government pays you will pay for another part of it. And then anything beyond that is your own personal savings and investments. And what financial planners will tell you is that you're going to need 70 to 80% of the salary that you were earning while you were working. You're going to need 70 to 80% of that in retirement in order to maintain your standard of living. Now, that might sound a little scary. How am I going to achieve that? But we have a whole section at the end of the presentation that I'll walk you through how to get pointed in that direction. And it's not complicated. You all are super smart, and it's actually pretty easy to figure out. So I will guide you through that. But I wanted to show you this slide right now because we're going to talk about the Acera monthly pension part of this retirement planning idea first. And then at the end of the presentation, we'll delve into the Social Security and the savings and getting you pointed in the direction of 70 to 80% income replacement. Okay, so to start off with, regarding more about Acera's pension, let me help you understand some pension math. And this will help you understand how you are actually, this will help you understand when I say that you're earning credit toward retirement, it will help you understand what that means. And it will also actually help you make a few strategic moves throughout your career in order to maximize your retirement. Okay, so it's really good to have an understanding of this. And it's not that complicated. Let me walk you through this. Okay, so here is the retirement formula. This is what we're going to calculate when you go to retire. This is what's going to determine your retirement allowance. Okay, so in retirement, you are going to get, as your monthly lifetime retirement allowance, you're going to get a percentage of your highest salary for each year of service that you work. Okay, now this equation is the math version of this sentence. Okay, so let me help you understand both. You have three factors here. You have an age factor percentage, you have years of service credit, and you have your salary, your highest average monthly salary. Okay, and so when you go to retire, you're going to get, when I say you're going to get a percentage of your salary for each year of service, let's say that the percentage of your highest salary that you're going to get for each year of service is 2%. Okay. And let's say for this example that you work for 20 years full-time or full-time equivalent. So that means you've earned 20 years of service credit. Okay, so we put those in the equation. That means you're going to get 2% of your highest salary for each one of those 20 years that you work. Each individual of the 20 years, you'll get 2%. That means that in total, you're going to get 40% of your highest salary for each year of service, because we simply multiply 2% by 20 years. So 2% for each one of the 20 years equals 40% of your highest salary. Okay, now your highest average monthly salary will be determined based on your payroll records, and I'll talk more about that later. But let's say that for this example, it's $5,000 per month. So that at the end of your career, that was your highest average salary that you were making per month. So in retirement, what we're saying is you're going to get 40% of that amount as your retirement allowance. So we simply multiply 40% times 5,000, we get $2,000. So that becomes your lifetime monthly retirement allowance. Okay. So that's how that works. Now, because this is a multiplication, the higher any of these three numbers are, the higher the age factor percentage, the more years of service credit that you have, the higher your salary that you earn in your career. Because it's a multiplication, that means that any of those numbers being higher, or all three of them, that's going to increase your monthly retirement allowance for life. Okay. So when I say that you're earning credit toward retirement, you're earning it in these three categories. You're earning it by getting older. You get a higher age factor percentage. You're earning it by working more years. So you earn more years of service credit in the formula. And you're earning credit toward retirement by having a higher and higher salary. Okay. And so these are the three components of the retirement formula, and that increases your retirement allowance. Okay, so we're talking about gross salary in this equation before any deductions are taken out. So I'll answer that question. And then there's a question, how do you get the initial percentage, the age factor percentage? So that's a good segue into further discussion of each one of those topics. So let me tell you a little bit more about each one of those three factors in the formula: the age factor percentage, the service credit, and the highest average monthly salary. Okay, so regarding the age factor percentage, the question is, what percent of your highest salary will you get for each year of service? Well, it is going to be based on which tier you're in, and it's going to be based on your age at retirement. Okay, so this is a sample age factor percentage chart that we're going to use to determine which percentage we're going to put in the formula for you. So when you go to retire, we're going to pull one of these numbers out of this chart and put it in the formula. Let's say that you're a general member and you're in tier 4 for this example. Okay, so you're going to retire at age 60, let's say. So what we need to do when we calculate retirement, we're going to go to general tier 4, we're going to go down to age 60, 1.80%. That is the percentage of your highest salary that you would get for each year of service because you retired at age 60 as a general member who's in tier 4. So when you're looking at this chart, you just look at the one column for your tier. Forget about all the other columns, okay? So if you're a general tier 2 member, you look at the general tier 2 column. If you're a safety member, you look at which safety column you are in, okay? And forget about all the other numbers. Now you may notice a few things about this chart. One is that the numbers get bigger the older you are when you retire, okay? So that's the way that these percentages are designed. The older you are when you retire, the higher the percentage of your highest salary you're going to get for each year of service. The higher this percentage is going to be that we're going to put in the formula for you. So if in that same example, tier 4 general member, you wait another 2 years and retire at age 62, you would get 2% of your salary. If you wait another 3 years, you would get 2.3% of your salary. So the numbers get bigger the older you are. Okay, now you may also notice that I skipped a bunch of the ages, and that's because they don't all fit on the slide, because there's actually an incremental increase with every quarter year that you age and don't retire yet. So if this were the full chart, it would say 52, 52 and a quarter, 52 and a half, 52 and 3/4, 53, and so on and so forth. And there would be an incremental increase for each one of those quarter year increases in your age. And it's based on your birthday. So if your birthday is January 15th, 1/4 after your birthday is April 15th, so you go up one notch in this chart. Another quarter after your birthday is July 15th, so you go up another notch in the chart. Another quarter after your birthday is October 15th, so you haven't retired yet. You go up another notch in the chart and you get a slightly higher age factor percentage. If you want to see all of the age factor percentages, they are posted out on our website. If you go to acera.org/age, or you can just search for age factors, there's a PDF that you can pull up that has all of them in it. Okay, so the question is, will the percentage change within the years as you age? So yes, so no, these percentages, okay, now these percentages are basically set in stone. So these are the percentages that you're looking at, but within your tier, the set of percentages that you're going to be working with in your tier, the older you are in your tier, the higher the age factor percentages that you're going to get. Okay, but this set of age factors will never change for you in your tier. Okay, and so I answered that question, and the question, yeah, you're welcome, of how do we get the age factor percentage. I'm going to hang on to the service credit questions, and I'll answer those in just a minute. Okay, so I gave you a lot of info about the age factor percentages. Since this is the new employee and mid-career seminar, your retirement might be a ways away. You may not remember all those details. They're posted out on our website if you ever want to revisit that or revisit this video out on our website. But really, the bottom line, the only thing that you really need to remember here is that the older the retirement age equals a higher the age factor percentage up to the maximum for your tier. Okay, so if you want to walk away and just remember one thing about the age factor percentages, that's it. Okay, so we talked about the age factor percentages. Let's talk about the service credit component of the formula, the years of service credit. Okay, so what we're talking about when you're earning service credit is you start earning service credit on your date of entry into Acera, whatever that date is. If you forgot what your date of entry is, you can log into your account on our website and it will tell you your exact date of entry. Okay, so that's when you start earning service credit, and you're going to earn it all the way until you stop working. Now, if you go straight into retirement, it will be all the way up to the day before your retirement date. So you will earn it up to your last day of work. In all cases, you earn service credit all the way up to your last day of work, but some people will stop working before they retire, and they'll retire at a later date, and they won't go straight into retirement, and they'll become what we call a deferred member because they're deferring their retirement to a later date. We will talk about that. And in that case, you stop earning service credit when you stop working. So basically, you earn service credit as you work. Now, you earn service credit during your regular work hours. You also earn service credit during your earned leave. So vacation leave, sick leave, management leave, comp time, holidays, floating holidays. You're already earning service credit during that time. That when you're out on that leave, that does not count against you for the purposes of calculating your retirement. And I think that answers a question that was up on the board. So it does count. Paid time off. Yep. During all of these leave times, you earn service credit. So that does not count against you. Okay, now there are times when you don't earn service credit. If you're ever out on leave without pay, you're not earning service credit during that time. Okay, because you're not working and you're on leave without pay. You're not earning you're not using your leave balances. You're just on leave without pay. Okay, also purchased vacation. If you purchase additional vacation on top of your earned vacation, and some of our employers will let you do that, like you purchase an extra week of vacation, while you go out on that purchased vacation, you do not earn service credit during that time. So if you mark your purchased vacation in your timesheet, like a week of purchased vacation, you don't earn service credit during that time. That's the bad news. The good news is like missing out on a week of service credit is not a big deal. So it's not really going to affect your retirement allowance that much over the span of your entire career. Okay, you also do not get credit if you sell your vacation back to your employer for cash. You don't get service credit for that. You also don't get service credit for overtime, on-call time, or standby time. Okay, now there is this concept of purchasing service credit, which is important to understand. Um, so there are some types of time that are eligible for you to purchase to increase your amount of service credit that we're going to put in the formula for you. So the main theme of the list here are it's like these types of time where if the circumstances were slightly different, you could have worked and you could have earned service credit, but there was some reason, there was some like slight circumstance that made it so that you were ineligible to earn service credit during that time. But then because of that, these types of time are purchasable. So let me go through the list. Okay, so these ones are, if you started out, it's called ineligible non-covered service purchase, and this is kind of what I'm talking about. Like if you started working part-time for your employer, and I'm not talking about working for a temporary agency or working under contract, those are not that time is not purchasable. But if it was just plain old part-time working for your employer, you were not an NESARA member yet until you got your full-time retirement eligible position. So then once you become an NESARA member, then you can purchase that part-time work. The same thing with the county's temporary assignment pool time. That's what TAP stands for. All of that TAP time is purchasable. Also, if you worked seasonal, intermittent, service is needed, project per diem work, that type of time is purchasable because you were not an NESARA member yet when you were working that time. Okay, now those days between your date of hire and date of in your entry date, so that 2 weeks, that's purchasable if you have that. Now, unpaid medical leave. So I do have a question up on the board. What about FMLA, which stands for the Family Medical Leave Act, which is a federal law that says that for certain medical reasons, you need to be allowed to be out on medical leave and maintain your job. And I think it's like up to 12 weeks, I think. So to answer your question, if you're out on sick leave and you're using your leave balances, and sometimes when you're out on sick leave, it will be designated as an FMLA sick leave. So for example, if you're out on maternity leave, that's designated as an FMLA sick leave. That's in the federal law. But you may be using your leave balances. So if you are using your leave balances, you're already earning service credit for that time. Now, it may be because the FMLA stretches out, you run out of your sick leave balances and then you're just on unpaid medical leave. Well, that is purchasable, the unpaid medical leave. So the unpaid part of that FMLA leave, that would become purchasable up to 1 year per instance of unpaid medical leave. So if you're out on unpaid medical leave for a year, you return to work, then you go out on unpaid medical leave for another year. Both of those periods are purchasable. State disability insurance leave is purchasable. So that's like if you're being paid from the state disability insurance system or the workers' comp system, that's purchasable. Sometimes you're paid part of your paycheck from your employer and part from that system. The part that you're paying, you're being paid from your employer, you're already earning service credit for that part. So the portion that you're being paid for the state disability insurance leave or workers' comp, that part would be purchasable because you didn't earn service credit for it already. Military leave during membership. If you go out on military leave, whenever you return from that leave, that's purchasable. So for the unpaid medical leave, the state disability insurance leave, and the military leave, when you return from those leaves, then those become purchasable. Redeposits of prior memberships. That's when you used to be an NESARA member in the past. You stopped working for your public employer. You took a refund of your contribution account. So all the contributions you paid in, you took a refund because you wanted to go do something with that cash. Okay, now you're back working for your public employer and you're a NESARA member again. If you want to put that money back, you can get your service credit back that you initially earned under that prior membership. That's called a redeposit of a prior membership. Now, there's also redeposit of community property. So this is when you get divorced or you dissolve your state domestic partnership and you're a NESARA member. Okay. And part of your retirement that you earned as a NESARA member while you were married or in that partnership got divided off and given to your ex-spouse in the divorce settlement. Now, your ex-spouse, if they take a refund of that money that got divided off to them, you can actually, at that point, we'll send you a letter letting you know that they did that, and you can redeposit that amount of money and get your service credit back that your ex-spouse took with them in the divorce settlement. And that's called a redeposit of community property. Okay, and then the last category is other California prior public service. So if you used to be in a SARA, I'm sorry, if you used to work for another public agency in California, such as some examples here are East Bay Mud, Port of Oakland, another county in California, another state job. If you were part of the CalPERS state pension system that state workers are part of, you could actually purchase that time as a SARA service credit if you were ineligible for their pension. And the reason that you're ineligible for their pension is because you took a refund of your contribution. You took your money out of their system. Now you can buy that time as a SARA service time. So like if you worked for the Port of Oakland for a couple of years and you took your money out of their pension system, you can buy that 2 years as a SARA service time. And we will calculate a contribution payment for you to buy. Okay, so there's a question. Is there a time frame for adding these amounts in or into Vest, or can you do it at any time during your employment period? The only time limit for making service credit purchases is you have to finish paying for them by the time you retire. So you have until you retire to make these purchases. Now, the longer you wait to purchase service credit, the more expensive it gets, and I'll tell you why in just a minute. Let me first talk about time that's not eligible for purchase. If you purchase extra vacation time, I already told you don't earn service credit for it. It's also not purchasable. So, but like I said, don't worry that much about it. And the good news is you got to take a nice vacation. Okay, so non-medical leave without pay is not purchasable. Oh, and let me say one more thing about the unpaid medical leave. It's only for your medical condition. So if you are taking care of somebody else, you're out on medical leave, you're using your sick leave because, or you're out on unpaid medical leave because you're taking care of somebody else's condition, that's not purchasable. It's for your medical conditions only. Also, if you're out on unpaid leave and it's not medically related, then that's not purchasable. Like I said, contract or temporary agency time is not purchasable. And if you're trying to purchase other prior public service from another agency, and you still have contributions on deposit in their fund, you can't purchase it until you take a refund of your contributions from their pension fund. Okay, so what is making a service purchase credit going to cost you? Because it's called a purchase, it does cost money. What it's going to cost you is your employee contributions had you worked that time. So for example, if you're out on 3 months of unpaid medical leave, had you been working during that time for that 3 months, with each paycheck, you would have been contributing to the retirement system at a unique rate to you based on your situation. And so whatever you would have had to pay, whatever the dollar amount would have been that you would have had to pay during that 3 months in this example, that is what it costs to purchase that 3 months worth of unpaid medical leave time, plus interest. So you have to pay, if you had worked that 3 months and you had paid into a SARA for that 3 months, we would have invested that money and that money would have earned interest. So you're going to have to pay any interest that money would have made. And we calculate that based on, we have 2 interest periods per year. One ends in June, one ends in December. And so every time the end of June passes and the end of December passes, that's another interest period that money would have earned interest. And so when we do our calculation to tell you how much it's going to cost, we're going to factor that in. So you're going to owe the interest that money would have earned between the time of that you're trying to buy and now. So if you're trying to buy 3 months of unpaid medical leave from 5 years ago, that's 10 interest periods that have transpired between then and now. And so you're going to have to pay all the interest that money would have earned. That's why I said the longer you wait to purchase service credit, the more expensive it gets. Another way to think about it is that the time to purchase service credit is as soon as you can. As soon as you know that you want to purchase that time and you're interested in purchasing that time, and as soon as you feel like you have the money to actually purchase it. So how do you actually do a service credit purchase and figure out how much it costs? What you do is you fill out our form. It's called a purchase redeposit request. You log into your account, fill it out. We're actually about to convert this over to DocuSign, so it will look a little bit different shortly, but it's an electronic form. We'll do some calculations and send you a letter in the mail with the cost. And at that point, you decide if you want to make the service credit purchase and how much of the service credit purchase you want to make. For all of the types of time except for the redeposit, you could purchase a portion of the time if you wanted. The redeposits are all or none. You have to either redeposit the whole amount or none. Also, one more thing about costs is that if you're trying to purchase other California prior public service time, that can be expensive because you're going to have to pay not only the employee contributions, but the employer contribution part as well. And it probably costs about triple what the other types of time cost. But we will tell you what the cost is going to be in that letter. And then you can also decide how to pay if you want to make the service credit purchase. You could pay in a lump sum on a post-tax basis. You could roll over pre-tax money from another retirement account if you have one. You could do payroll deductions. So we'll split it up for you over the amount of time that you're trying to buy maximum. So if you're trying to buy a year's worth of time, we'll split it up for you in payroll deductions over a year, or any combination of the three options above. Okay, now I usually get this question, is purchasing service credit worth it? And how do I figure that out? Well, you can figure this out for yourself. What you do is you log into your account on our website. Inside your account, you will find a thing called a benefit estimator. Okay, this helps you make projections of what your retirement allowance is going to be should you retire in a certain scenario. So you work a certain number of years and you have a certain retirement date, and it will project into the future what your retirement allowance will be using that tool. So it's a pretty powerful tool. And if you haven't used it yet, it's actually super intuitive. So I recommend it. Getting in there and playing with it. Okay, so what you're going to do to figure out whether purchasing service credit is worth it is you get into the benefit estimator tool and you do two estimates. Estimate number one, okay, in both estimates, you're thinking of the same retirement date. It's the same retirement scenario. Okay, in estimate number one, you leave the service credit override field blank. Okay, so in this estimator, it projects how much service credit you will have earned in this scenario that you're doing, retiring on retirement date X. You have the opportunity to override that number. You don't in estimate number one. You leave it blank and you press the submit button and you get your estimate number one, and it tells you what an estimate of your lifetime monthly retirement allowance is going to be under estimate number one. Okay, then you do a second estimate, estimate number two. Same retirement date, same retirement scenario, except the one difference is that you will override your service credit. So you're going to take the service credit number that they give you that you have already earned in this scenario, and you're going to add to it whatever you are planning on purchasing. So for example, if on retirement date X, you will have earned 20 years of service credit and you're thinking about purchasing 6 months worth of service credit, you will add the 20 years plus the 6 months is a half a year. So 20.5 is what you'll put in the service credit override field. And then you'll hit submit again. You'll see that the estimate that comes out of that will be a little bit higher because there's more service credit in it. Okay. Oh, and I actually have a screenshot here. Sorry, I forgot about that. Okay, so this is the benefit estimator. These are the retirement dates that we're talking about. So this is your projected retirement date. This is your separation date, which has to be at least the day before your retirement date. And then this is the amount of projected service credit it's giving you in this scenario. And this is where you would put the override amount in estimate number two. The difference between separation date and projected retirement date is separation date is your last day of work or your last day on payroll, basically. Retirement date is your first day of retirement. For a lot of you, it'll be consecutive days, like in this example, but for some of you, it won't. You'll stop working, maybe 5 years from now, and you will defer your retirement, for a few more years after that. And so in that case, you would have a separation. You would have a gap between these two dates. But if you're going straight into retirement, then these would just be consecutive dates. If you don't know what you're going to do, just do consecutive dates. Just pick a retirement date, whatever, how many, 10 years from now or whatever, and then put the separation date as the day before. Okay. So yeah, so again, this is the override service credit field that you will be using for estimate 2. You hit get estimate. Okay, and then you end up with 2 estimates. Now, you just take the difference of them. You subtract the smaller one from the bigger one, and that tells you what the effect of purchasing the service credit will be on your monthly retirement allowance. Your monthly retirement allowance went up by a certain amount of dollars because of that service credit purchase you made. And then you take the service credit purchase costs that we send you in the letter. We say it's going to cost $5,000 to make the service credit purchase or whatever it is. And then you simply divide that big amount by the monthly difference, and that tells you how many months it's going to take you to get your money back in increased retirement payments. And you could even divide by 12 again to tell you how many years it's going to take. Now, if it's going to take a few years, 2, 3, 5 years in increased retirement payments to get your money back that you paid for the service credit purchase, it's probably worth it because you're going to have a larger retirement allowance for the rest of your life based on having made that service credit purchase. If it's going to take a long time to get that money back, 10, 15, 20 years, that's when you start weighing whether it's worth it to make that service credit purchase or not. So that's how you figure that out for yourself. There's a question, do you have to work for 5 years to get any return? Sort of, but not really. And I'll talk about that in the second half of the presentation when I talk about your options for when you're going to leave your job. Okay, so I'll come back to that question. And the question is, do you have to work 5 years to get vested? To get vested, yes, you have to have 5 full-time years of work or the equivalent of 5 full-time years. So 10 half-time years or whatever the equivalent of 5 full-time years is, then you're vested in the retirement system. And that will include reciprocal work, which I'll talk about reciprocity also in the second half of the presentation. Okay, so we talked about the H factor percentage. We talked about the years of service credit. Let me tell you about the salary component of the formula, the highest average monthly salary, and how we calculate that. When you go to retire, we are going to have our software go through your payroll records and find your period of highest pay in your entire career. This is known as your final compensation period. If you're in tiers 1 and 3, your final compensation period, your period of highest pay in your career, is your highest consecutive pay periods, and it's 26 biweekly pay periods or 12 monthly pay periods, depending on whether you're paid biweekly or monthly. For tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. Essentially, for tiers 1 and 3, it's your highest year of pay. For tiers 2 and 4, it's your highest 3 years of pay. That is your final compensation period. Okay. So then our software, what it's going to do is our goal is to find an average that you were making per month over that period of highest pay. So we'll simply divide by the number of months in that period to get an average. Divide the year of pay by 12 months, divide the highest 3 years of pay by 36 months, and that tells us your highest average monthly salary over that final compensation period, which again is your period of highest pay during your career. Okay. So that is how we arrive at that number to put in the formula, the highest average monthly salary. Hang on, there's a question up here. Okay, there's a question going back to service credit. So let me just dip back into that for a minute. So the question is, how do you calculate the service credit you want to purchase? What kind of documentation do you need to provide to show that you are working part-time? Okay, so that is in the purchase redeposit request form. You don't have to calculate the amount of service credit you want to purchase. You simply estimate the time that the type of, you tell us what type of time you're trying to purchase, and you estimate the time period that the time takes place. You estimate when that time is that you're trying to buy. So if it was like 3 months of unpaid medical leave 5 years ago, then you say, you kind of estimate the months that time took place. And then our staff, when we do our calculations, will go back through payroll records, and they will calculate the exact amount of time that is purchasable. And they will tell you that in the letter. They may need to do research and call different departments. So these requests can take some time, especially if the departments aren't being responsive. Occasionally, we'll reach out to you and ask you to contact your former department because, try to get them to respond. So occasionally you might need to do a little research, but for the most part, our staff will do the research and do the calculation for you. Absolutely. Okay, so back to the salary discussion. Okay, there's a question. So for tier 2, you have to be at your highest salary for 3 years or more to count toward your retirement allowance. No. You, whatever your salary is, whatever your highest consecutive pay periods are, that's what becomes your final compensation period. So let's say that in at some point in your career, toward the end of your career, most likely, usually these periods are at right at the end of people's careers, but sometimes not. At the end of your career, let's say the last 3 years, you're making $20 an hour for that first year of that period. And then the second year, you're making $25 an hour. And then the third year, you're making $28 an hour. Well, we will see all of what your actual pay was during those periods of highest pay. And whatever your actual pay is, that gets totaled. So whatever your pay is over the highest 3 years, that gets totaled. That's a total dollar amount. And then we divide that dollar amount by 36, and that tells us your highest average monthly salary over that time. So you don't have to have the same salary over that entire time. Okay, now what pay is included in the highest average salary? So pay that you see in your final compensation period, if base pay, of course, is in there. And again, we're talking about gross pay before any deductions are taken out. So your base pay is going to be in there. Some footnotes might be in there, or also there are other pay codes. These are usually based on your different skills you have or education levels. These other pay codes, some may count, some may not count. There's 1,000 pay codes. So you can figure this out for yourself, whether your footnotes or other pay codes count by going to our page, Acera.org/pay codes, and there's a list there for your employer, and you can search for your pay code, and it will tell you yes or no whether it's going to be in or out of this equation. But overtime never counts. That's the one I do know. And then if you are in tiers 1 and 2, if you sell vacation during that period, that final compensation period, or if your final compensation period comes at the end of your career and you cash out vacation, you have vacation left over in the books that they pay you out at that time, then some of that can be included as well, up to a limit. I'm not going to take a deep dive into that, but we do have a page on that on our website about how much vacation can count toward your salary. Okay, for tier 4 members, there is a limit to how much salary we're allowed to include in the calculation. This was something that is written in the state's law when they created tier 4 in 2012. So for general, and these are annual caps. For general members, currently the 2022 cap is $134,974. For safety members, it's $161,969. The way this works is, if you do have a high salary that is more than that, once you hit that salary cap for each calendar year, we will stop taking out contributions from your paycheck to go to Acera. So that leaves more money in your paycheck for you to invest in your 457B plan or wherever you want to invest it. But whenever you go to retire, we can't include more annual money than this capped amount for you in the salary component of the calculation. Now, these numbers go up every year. It's based on a calculation done by the federal government, and these numbers go up every year. So by the time you retire, these numbers are going to be a lot higher. You can find more on that at acera.org/limits. And yeah, and this is gross salary. Okay, so here's an example of the whole thing put together, the retirement formula. In this example, a tier 4 member retires at age 65 after earning 25 years of service credit. And so their age factor percentage based on them being in tier 4 and them retiring at age 65 is 2.30%. That comes from that age factor chart. We multiply that by the 25 years of service credit that they have earned. We multiply that by their highest average monthly salary, which in this example is $6,000. And that gives them a monthly retirement allowance of $3,450 that they will get every month for the rest of their life, plus cost of living increases every year. Now, if you multiply these two numbers together, that tells you what percent of their salary that they're getting. In the example I gave you at the beginning of the presentation, it was the 2% times 20 years of service to get the 40%. And what we call this, another name for this is like the percentage of salary replacement that you are achieving. So in this case, they're achieving 57.5% salary replacement from their retirement allowance alone, which is really great. So even though 3,450 seems like a lot less than 6,000 that they were making, that percentage is actually pretty good. And I'll dive deeper into that in a little bit later. Like I said, you're trying to aim at 70 to 80%. And they'll be able to make that up with Social Security and savings. Okay, question. Do we still pay retirement contributions after we retire? You do not. You are done contributing, and it is your time to collect on the retirement that you earned. Okay, the next thing we'll talk about is getting a pension estimate. So let me help you understand how to get a pension estimate. I'll show you two ways. The first way I'll show you is how to get a kind of salary replacement number. You get an idea of how much your Acera benefit is going to replace your working salary. And it's really simple to do. We have charts that help you do this. If you go to acera.org/planning, you can find a chart for you, but I'll actually show you how to get there without typing it in. So here's our website. You go under members and you just go down to planning your future retirement income. And the very first thing there is 4 ways to get an Acera retirement estimate. And the very first option is using one of these charts. So you press the button for your tier. I'll go ahead and press the general tier 4 button. A lot of people are general members in tier 4, which is, I use them as an example. Okay, and then here's your chart. So let me get rid of this. I'll zoom in here. What we've done in the chart is we've already multiplied out the age factor percentage and years of service for you to get the salary replacement number. And so all you do is you find your age at retirement at the top. So you think of a scenario. I'm going to retire at age 60 with 20 years of service credit. What salary replacement percentage am I going to get in that scenario? So the way that you're doing it is you're thinking, okay, if I retire at age 60, how many years of service credit will I have at that time? Maybe I'm already 45. And I've already worked for 5 years, and that's going to be another 15 years. So that's 20 years. Okay. So at age 60, if I have 20 years of service credit, I'll just find where they intersect, and I'm going to get, let me make sure that I did that right. 36% income replacement, which means that I'm going to receive as my retirement allowance 36% of what my working salary was. Okay, so another thing that you can do with this chart is you can think about what will happen if you work an additional year or 2 or 3. And all you do is you find where your scenario intersected, and then you go down diagonally. So if I work another year, I'm going to be a year older, 61, and I will have 21 years of service credit. So that would be 39.9% of my salary will be my retirement allowance. If I work another year, it'll be 44%. If I work another year after that, 48.3%. And so that's kind of how you can see what the impact of each additional year of service credit and age will do for you. So that's one way to get a kind of ballpark estimate of what your retirement is going to be. That doesn't tell you a dollar amount, but it tells you what percentage of your salary you're going to get. Let me go back over to the presentation. Okay, the second way to do this that will give you a dollar amount is by using our benefit estimator on our website inside your account. So all you do is you go to our website, acera.org, you click on the login button, If you have never logged in there before, you'll have to create an account. But once you get in there and answer the security questions and create your username and password, you'll find your pension data sitting there waiting for you, because this connects to our pension database. So one thing that you'll see in there is the summary page, the first thing. It'll show you what your tier is, your employer, whether you are actively working or you're a deferred member or you're retired, whether you have reciprocity, your entry date into a SERA, your employment date, how much service credit you've earned, how many contributions you've paid. There's a lot of data in here. So it's a really powerful tool. You're going to click on estimate a benefit. And once you get there, you'll see the benefit estimator tool. Okay, I'm going to zoom in here. And these are all screenshots that I'm showing you, just to give you an example. So what you're going to do is you're going to pick a retirement scenario. And since this is a new employee mid-career seminar, maybe you don't have an exact retirement date, but all you need to do is just think, well, what if I retire in 10 years? Or what if I retire in 5 years? Or what if I retire in 15 years? And then just kind of pick a date that kind of corresponds with that. So like, let's say that if I retire in 10 years, I'll be 55. Let's see what happens let's see what my retirement allowance is going to be if I do that. So you just write in dates here. And like I said earlier in the presentation, your separation date is your last day on payroll. Your projected retirement date is your first day of retirement. And these need to be at least consecutive days. So the separation date has to be at least the day before your retirement date. If you're going straight into retirement, these would be consecutive days. If you're going to stop working and then defer your retirement to a later date, maybe there's a gap between these days. Okay. So you just put in whatever scenario works for you and you hit calculate. And what it does is based on these dates and based on what it already knows about you, it will do a service credit projection for how much service credit you will have earned in this scenario that you're doing. It will also project your salary based on your current highest salary. If you're going to retire many years from now, this is probably not that accurate because you'll probably see cost of living adjustments and raises throughout your career. So you do have the opportunity to override your service credit and your salary. If you want a nice conservative estimate where you're not overestimating, you might want to just leave both of those blank. Okay. And then go ahead and leave this hours of cash vacation compensation blank. You can put in beneficiary information here. If you want to see information about your beneficiary, if you can select a beneficiary from the dropdown, if you've already designated your beneficiary with the SERA. If you do that, make sure the birth date is correct, and then click Get Estimate. And what you will end up with is this is a PDF of your retirement benefit estimate. And we're redesigning this. This might look a little bit different whenever you're watching this later. But this is what it looks like right now. So this is the estimate of your future retirement allowance, your future retirement benefit that you're going to get monthly for the rest of your life based on what you put into the estimator. So I'll just zoom in here so you can see it a little bit better. Up here is it's the numbers that it's using to calculate the estimate. And down here is the estimate for each one of the different retirement options that you will be choosing from at the time of retirement. Now, you don't necessarily really want to worry about which option that you're going to pick now because your situation is probably going to be a lot different by the time you retire. So for right now, as a new employee or a mid-career employee, just go ahead and look at this number right here, the unmodified option member allowance, because this one is the one that most people take because it pays the highest retirement allowance to you, the retiree. So you can just go by this number as your retirement allowance estimate. Okay, so then there's a question, how soon can you start receiving a pension? What are the benefits, if any, of deferring retirement? I will go into all of that. Actually, I'll go into all that right now. Understanding retirement eligibility. What we're talking about when you actually become eligible to retire is this date on the pension milestone chart right here. Okay, so this is your retirement eligibility date. This is the first day that you could actually physically retire from a SERA if you choose to. And like I said, it's going to be based on a combination of your years of service credit and age. So what combination? Well, for tiers 1, 2, and 3, there's 3 different ways. There's 3 different combinations that get you retirement eligibility. For tier 4, I'll show you that slide in just 1 minute. So for tiers 1 through and 3, option 1 to become eligible to retire is that you are at least 50 years of age and you have at least 5 years of service credit, which means you're vested in the retirement system, and you have at least 10 years of membership in the retirement system, which means that at least 10 years has passed since your date of entry into ACERA. So some of you might work for somewhere between 5 and 10 years, and then you stop working. And if you're over age 50, you still can't retire yet. You have to wait until 10 years has passed since your entry date. I'm not sure why that's written in the law, but that's just the way it is. So if you're going straight into retirement as a tier 1, 2, or 3 member, you're planning on working straight into retirement, you kind of think of it as 10 years of service credit and be over age 50, and then you retire. But if you did need to quit before that 10 years, you would still be vested and you could retire once you achieve that 10 years of membership. Okay, option number 2 is that as a general member, you can have 30 years of service credit, or as a safety member, you can have 20 years of service credit and you can retire at any age, even if it's younger than age 50. Okay, option 3 is that you can be age 70 and retire with any amount of service credit, even if it's less than the 5 years that you need under option 1. So those are your 3 options for being eligible to retire. For tier 4, you have 2 options for becoming eligible to retire. Option 1 is that as a general member, you're at least 52 years of age. As a safety member, you're at least 50 years of age, and you have at least 5 years of service credit, and then you can retire. You will, so you don't need to work, 10, 15, 20, 25 years. You could draw a retirement allowance from ACERA with just 5 years of service credit. It's not going to be a big retirement that, you're probably going to want to count on leaning on that for the rest of your life. You're probably going to want to have some other income, but that pension from ACERA based on that 5 years will probably pay a whole bunch of your bills in retirement. So it's going to, continue for the rest of your life. So it's still a pretty powerful thing. Now, option 2 is that you are age 70 and you can retire with any amount of service credit, even if it's less than 5 years. So this goes back to that question earlier in the presentation. Do you have to have 5 years to get any return? Not really, if you're willing to wait to age 70 to draw a pension. If you have less than 5 years, you can retire from ACERA at age 70, and then you would get a lifetime pension based on whatever service credit that you have earned, even if it's not 5 years worth. Okay, let's see. I have some questions up here. Okay, let me do this question first. Your tier 2, am I saying you can't retire until you have 30 years of service? Nope, that's not what I'm saying. You can retire as if you're over age 50, as long as you have 5 years of service credit and at least 10 years of membership with ACERA. So if it's already been 10 years since you were, if it's already been 10 years since your date of entry into ACERA and you already have 5 years of service credit and you're already over age 50, then you're already eligible to retire. So you can do option number 1. You don't have to do option 2. Okay, then let's see. There's a question about that goes back to the benefit estimator regarding reciprocity. You're not going to see any reciprocal service in this. This is ACERA's estimator only. So the only service credit that you're going to find appearing in here is your ACERA service credit, because we don't have any of the pension data from any of the other systems, because all the systems are separate. It's just that they're linked together in certain ways in terms of calculating your retirement, but our databases are not linked up. So to get an estimate for what that reciprocal agency is going to pay you, you should go to their website. And if they have a member portal that you can log into and do an estimator, then you can do an estimate get an estimate from them, because they're going to send you, you're going to retire from all of the systems, all of the reciprocal systems on the same day, but we're all each going to individually send you a retirement payment. And so you need to go over to their system to see what they're going to pay you. There's a question, is there also reciprocity from, yeah, you're welcome. Is there also reciprocity from Acera to CalPERS or another county state system? Yes, and I'll go into who we have reciprocity with when I get there. Which is, I think, maybe the next topic after this one. So let me help you understand some additional benefits that we offer. Okay, so I talked about the vested benefits, which is the retirement allowance for life, death benefit, and the cost of living adjustment. There's also some other benefits. There's some non-guaranteed benefits like medical, dental, vision. There's also disability retirement, which is considered a vested benefit, like kind of part of the vested benefit. If you become permanently disabled and you cannot perform your job duties anymore, you can apply for disability retirement. And if you're awarded a disability retirement, then you would have a disability retirement payment rather than the service retirement payment. But it's the calculations are kind of similar. And but there are advantages to disability retirement. I'm not going to take a deep dive into disability retirement in this webinar, but we do have a whole disability page on our website that will help you understand disability retirement if that's a topic that you're interested in pursuing. There's also death benefits. If you die before retirement, there are death benefits offered to your beneficiaries. Also, if you die after retirement, there's a different set of death benefits. So these are some of the other benefits. Let me talk real quick about medical, dental, vision. Okay, so there's this list of non-guaranteed benefits. They're kind of like extra benefits that are provided by Acera because at some point in the past, the county decided that the retirees needed these extra set of benefits to pay for their lives. And so they started a reserve fund in order to pay for these benefits. So these are paid out of a reserve fund that is part of Acera's fund. It's called the Supplemental Retiree Benefits Reserve. And the current set of benefits that are offered are medical subsidy, dental subsidy, vision subsidy, Medicare subsidy, and supplemental cost of living adjustment. Okay, MMA stands for monthly medical allowance, which is just the name of the medical subsidy. And so these benefits are determined by the Board of Retirement. They keep track of how much of these benefits are being paid out annually. They keep track of the sustainability of that reserve fund. And so they make adjustments year to year, maybe. They're tracking it annually because they want to make sure that fund stays sustainable so they can keep paying out these benefits into the future. Okay. So that's just my way of explaining that these are not guaranteed benefits. These are based on the balance of this reserve fund. Now, currently there's $1.1 billion in this reserve fund. So it's, pretty sustainable right now. There's a lot of money in there. So what gets paid out of there are these, non-guaranteed benefits, these subsidies. So once you're a retiree, if you qualify to receive these subsidies, then you can, you'll be paid out these subsidies into your retirement check. And this is like extra money on top of your retirement allowance. Now, to qualify, the board also sets up the rules on who qualifies. And so most of the qualifications have to do with years of Acera service credit. So for the supplemental cost of living adjustment, which is an extra cost of living adjustment that maintains your buying power in retirement, you don't need any years of Acera service credit to qualify. Everyone has access to that no matter how many years of Acera service credit they have. But all of the other benefits start at 10 years of Acera service credit. And notice I say Acera service credit. I'm not counting reciprocal service credit in here, okay? And then if you achieve 15 years of Acera service credit or 20 years of Acera service credit, you get a little more money for the medical to pay for your medical plans. These benefits change, like the plans change from year to year and the dollar amounts change from year to year. So I'm not going to go that far into it in this new employee mid-career seminar because it might be a little bit different by the time you get there. If you do want a more detailed explanation of this, you can watch one of our pre-retirement seminar videos. But the thing that I'm trying to illustrate with this slide and this discussion right now are these years of Acera service credit to qualify. So this kind of helps you plan out your career. If you know that you start accessing most of these benefits at 10 years, maybe that helps you figure out, whether you want to stick around for 10 years or not. So maybe you're at like 9.5 years and you're thinking about quitting and going and doing something else. Maybe you don't want to do that, because if you stick it out another 6 months and get over the 10-year mark, this actually will represent quite a bit of money in retirement. There's money to pay for your medical plan, dental and vision is paid. The premium is paid in full currently. And then once you're Medicare eligible, it's a subsidy that pays for the whole cost that you have to pay for the government to the government for Medicare. So it's quite a bit of money that is like extra money on top of your retirement allowance. So I just wanted to tell you about this. And in fact, I'll even put another pension milestone on the milestone chart. Healthcare subsidies start at 10 years. So you may want to think about that when you are planning out your career. Okay, let me talk about designating your beneficiary or beneficiaries and keeping them current. What is a beneficiary? That is simply someone who gets a benefit. And your Acera beneficiary is the person you designate to get your Acera death benefits after you die. Okay. So you may have, and you probably have already designated an Acera beneficiary. We asked you to do that on your enrollment form into Acera. You also have had the opportunity, and you continue to have the opportunity to redesignate your beneficiary to change who that person or persons are. So if, and let me talk more about that in just a minute. Let me tell you what the death benefits are before I go there. So should you die before retirement? So we're talking about death benefits. Should you die before retirement? Should that happen? If you are not yet vested, the death benefit would be a return of the balance of your contribution account. So all of the contributions you paid in to Acera, plus all the interest that we've paid on top of those contributions every time we earned interest. Your beneficiary would receive a return of those contributions. Plus, they would get 1 month of salary for each year of service, up to 6 months worth of salary. So for example, if you've already worked here for 4 years, they'd also get 4 months worth of your salary. So these are people who are actively working, but who are not yet vested. Now, if you are actively working and you're vested, what your beneficiary, actually, I think, yeah, if you're actively working and you're vested, your beneficiaries will get an expanded set of choices. They still have that first choice, which I just mentioned, which is option 1, a return of your balance of your contribution account plus 1 month of salary for each year of service up to 6 months. Or they could pick option 2, a monthly survivor's allowance. And if it's a spouse or state registered domestic partner, they would get that every month for the rest of their life. If it's a minor child, they would get it. There's a cutoff date, which you can look more into on our death benefits page. That's who a qualified beneficiary is: spouse, state registered domestic partner, or minor child. Option 3 is a hybrid of options 1 and 2, which is 1 month of salary for each year of service up to 6 months and a reduced monthly survivor's allowance. But if it is a spouse or state registered domestic partner, they would get that every month for the rest of their life. And you don't pick which option on your beneficiary designation. They are offered the choice when the time comes, or should the time come. So hopefully that time doesn't come. Hopefully you retire and live a long life after that. And then there's an entirely different set of death benefits, which we talk about in the pre-retirement seminar. Okay, now if you're a deferred member and you die before retirement, which means you're still an Acera member, but you stopped working and you have deferred your retirement to a later date, the only option is a return of the balance of your contribution account. Okay, now, if you want more info on that, well, our death benefits page is acera.org/death. Okay, so more about keeping your beneficiary designations current. You can change your beneficiary at any time. Simply fill out our beneficiary designation form on our forms page. You can also check who your beneficiaries currently are. If you log into our website, you go to our web page, you press the login button, or you can go to acera.org/WMS, which stands for Web Member Services. And when you go in there, you press the nominated beneficiary button and you can see who your active beneficiaries are. If you get in here and you see that your beneficiary is your spouse from 3 spouses ago, you're probably going to want to go ahead and redesignate your beneficiary, by filling out that beneficiary designation form. And that form takes effect immediately when we receive it. So maybe you want to check on that today and go ahead and do that today. Okay, so let me help you we're closing in on the final few topics. Let me help you understand your career planning options. So this will go to answer some of those earlier questions, especially about reciprocity and deferring retirement. Oh, and there's a question that I didn't answer. Will the highest salary also consider overtime? The overtime does not count in the salary calculation. So sorry about that. Okay, so you at some point are going to stop working at your job. Okay, so it is inevitable. You're not going to work at your job until the sun burns out. You're going to stop working at your job. So what are your options? Well, option number one is that you work straight into retirement and retire from Acera. A lot of people do that. You work your whole career for your agency or one of Acera's agencies, and then you retire from Acera. And if you do that, you will earn service credit right up until your retirement date. Also, we will convert your sick leave that you have left over on the books into service credit on a 2-to-1 basis. So you'll basically get half of your sick leave as service credit. You can even go work somewhere else if you want, especially if it's not for any of our 6 participating employers. We're going to consider you an Acera retiree. You're going to get your lifetime monthly retirement allowance for the rest of your life. If should you retire early, like at age 50 or 52 or 55, that's great. You're going to get your pension fund starting on your date of retirement, your pension, and then you're going to get it paid out to you every month for the rest of your life. And yeah, you can get your Acera retirement at the same time that you're working somewhere else if you want. Okay, option number 2, rather than going straight into retirement, you're going to terminate. You're going to stop working and not retire yet. Okay. Or you're going to stop working and you're going to not want to collect an Acera pension, either ever or just not yet. Okay. So terminating before retirement is option 2. And within option 2, there's kind of 3 sub options, which I'll call A, B, and C. Okay. So should you stop working and not go straight into retirement, you have 3 sub options. And what I'm going to do is I'm going to even add another milestone to the pension milestones chart. If you're going to be in this scenario, you're going to start earning service credit when you enter Acera, and you're going to stop earning service credit when you stop working, when you terminate your employment. And then maybe you'll retire at a later date. So those would be 2 separate milestones for you. Okay, so options A, B, and C, if you're terminating your employment before you retire. Option A is you become a deferred member. Okay, that deferred member means that you stop working and you're deferring your retirement to a later date. You're still an Acera member, okay? And your contributions, the reason that you're still an Acera member is because you have left your contributions on deposit with Acera. So there's still your contributions sitting in your contribution account at Acera, and that maintains your Acera membership. If you should do that, interest will continue to accumulate. Every time our fund earns interest, we post interest to all of our accounts and all of our member accounts. In fact, there's no negative interest. And people ask me what I mean by that. I mean that there's no risk. Your balance of your account can never decrease if we experience adverse investment experience. If we see adverse investment experience, your balance can never decrease. There's no risk. So if we lose money, we don't take money out of your account. So whatever your account balance is, it can only go up, which is amazing. There's no other place I can think of that earns the kind of interest that we earn that has no risk like that, where there's no, you're never going to lose money. Okay. So it's pretty amazing. Okay. Also, as a deferred member, you can retire later. So you can retire out of deferred status. And a lot of people might do that because you stop working before you're eligible to retire. And then once you reach that age requirement or whatever it is that you need to be eligible to retire, then you retire later at that time. Another reason people might defer is because you might come back and work later. You think maybe I'll come back and work later. Well, you can do that. As a deferred member, you're just kind of on hold. So if you return to your agency or one of our other 6 agencies, then you can just kind of pick back up and earn more credit toward retirement. So you kind of pick back up where you left off. Okay. Or you could be refunded at any time. So you're going to see the option C is taking a refund of your contribution account. Now you can do that at any time as a deferred member. You don't have to decide that immediately upon terminating your employment. So sometime later, if you decide you want to take a refund, you could be refunded at that time. That's option A. Okay. Option, let me think. Should I say one more thing about this? Okay, let me hang on to that, and I will talk about that in just a minute. Okay, and then there's a question about being a deferred member. Deferred members still need to contribute and pay with every paycheck? No. As a deferred member, you're on hold and you've terminated your employment, so you're not getting paychecks from your employer, and so therefore you don't need to make any contributions. So you're not earning any more service credit, but you're also not making any contributions to the retirement system. You're just kind of on hold. You've already earned the amount of service credit that you're going to earn, and you've already paid in what you're going to pay. Okay, option B is establishing reciprocity. Reciprocity is where we link a SERA with another public retirement system in California. So we have reciprocity with many cities in California. We have reciprocity with all California state jobs except for the UC system. Any agency that uses CalPERS as their pension fund. So some cities and smaller counties, rather than having their own pension system, they contract with the state system, CalPERS, to provide pension benefits to their employees. Excuse me. So if you are going to work for one of those agencies that has CalPERS, then we have reciprocity with them. There's a full list if you go to acera.org/reciprocity. The benefits of establishing reciprocity are, one, that okay, let me actually give you, let me see here. There's a question, can reciprocity be established with the federal government? No, we don't have reciprocity with the federal government. It's in it. So sorry about that. It's a totally different system. Okay, let me do this and then I'll explain reciprocity a little bit more. The benefits of reciprocity are that service credit you earn in all the systems combined is used for vesting and retirement eligibility. So let's say that you work for 4 years for Contra Costa County, and then you come over to Alameda County and work for 1 year. That means that combined, if you have linked those systems together and you have established reciprocity, combined you have 5 years, and that gets you over the vesting requirement for both systems. You're considered vested in both systems. And also for retirement eligibility, that gets you over the 5 years or whatever you need for the retirement eligibility as well. Okay, the second benefit of establishing reciprocity is that the highest salary that you earn under any of the systems will be used by all of the systems when they calculate your retirement. So for example, let's say that you work for Contra Costa County for 10 years and you make $25 an hour. Okay, then you get a job over in Alameda County and you work for Alameda County for 15 years. And let's say that you're making, what did I say? $25. Let's say you're making $35 an hour. Okay. Now, when you go to retire, you're going to retire from all the systems on the same day. We're each going to do a calculation for you. Contra Costa County is going to do a calculation based on your 10 years over there, based on whatever age factor you have over there, based on whatever tier you're in over there. And then when they get to the salary part, they're going to see in their system that you have reciprocity with the SARA, and they're going to call us and ask for your salary. And if it's bigger than what you were making there, they're going to use the bigger figure that you made under a SARA. And of course, then a SARA is going to use the salary, your highest salary here, your 15 years here, and then your age factor percentage here. And we're both going to do a calculation, and we're both going to send you a payment. So you get paid separately from each reciprocal system you link together. And then the third benefit is that if you are in tiers 1, 2, or 3, it keeps your contribution rate lower. For tier 4, it doesn't, because everyone pays the same contribution rate, which it's a little complex and I won't get into it. But if you want to know your contribution rate, we have a whole page on your contribution rate. I think it's sara.org/contributions. And so you can link multiple retirement systems together. Like you could, if you find a higher paying job in a different county, you can go over there, like in Marin County, for example, you go over there, work for a few years, and then you see an even higher paying job in San Francisco County, you go work there a few years, and then you see, oh, there's the job I really always wanted in Alameda County. You can come back here. As long as you leave all your contributions on deposit with all the systems that you're linking together, and no more than 180 days. There's no more than a 180-day gap between when you terminate your first job and you enter the next retirement system, which is about 6 months. You also don't want to have overlapping service. So you don't want to go on, like, if you're ending your job here, you don't want to take like 5-week vacation to use up your vacation at the end of this job, and then immediately start on payroll at the next place that you're working for. That's overlapping service, and that will disqualify you from establishing reciprocity. You just want to, terminate your employment here, go start the new job. And they're going to cash you out for your vacation anyway, so you don't even have to worry about it. Also, you have to retire from all the systems on the same day. Okay. And that holds reciprocity together. So that's how reciprocity works. So yeah, I answered that question. Who do we have reciprocity with from earlier? Let's see, there's some more questions on the board. If I have 17 years of service credit under tier 2 and start working as a safety employee, how long would it take to become a safety tier employee? I think as soon as you graduate if you're going to become a sheriff's deputy, as soon as you graduate the academy. So it might be like, I think the academy may be 45 days. I'm not exactly sure, but it's like maybe a few months. But then you become a safety employee, and then you would have safety. You would be in the safety tier, and so whatever service credit you earned, we would do a split calculation for you. So that 17 years that you earned under tier 2 general, we would do a calculation for that based on that age factor percentage and the 17 years. And then we would do a separate calculation for your safety service credit and your safety age factor percentage. We would get $2 amounts, and then we would combine them and send you one check. So that's how that works if you become a safety member. Okay, on the ACERA website, the date list is entry re-entry is totally wrong. It's several years off. How do I get this fixed? Oh, you should definitely send us an email. So go to acera.org/contact, or you can find the contact us on our page, or you can call us, and the phone number is 510-628-3000. And I'll show you that at the end of the presentation too, 510-628-3000. Okay, and so, yeah, you definitely want to go ahead and contact us about that. Okay, there's a question about reciprocity. If I have 2 years for reciprocity, and let's say tapped for 13 months, and if I was able to do a purchasable service credit, would that mean I only have 2 more years to be vested? So you have 2 years of reciprocity. You have tapped for 13 months. So that's about a year. Let's say it's 12 months. So that's a year. And if I have to do purchasable, and if I was to do purchasable service credit, will that mean I only have 2 more years to be vested? Yeah, that's right. Yeah, you have 2 years of reciprocity. You buy a year from TAP or a year plus from TAP. That's 3 years. Then you only need to work 2 more years and then you're vested. Yep, you got that right. Okay, there's a question. What is the benefit of terminating employment but not retiring until a later date? Okay, there's three benefits. And thank you for asking that question because this is what I was going to bring up after talking about reciprocity. Okay, so the benefit of becoming a deferred member. There's three good reasons to become a deferred member and one bad reason. The three good reasons are, let me go back to the deferred page. The three good reasons are that you're done working, but you're not ready. You're not eligible to retire yet. So you're done working, but you're not eligible to retire yet. Maybe you're younger than age 50 or 52 or whatever the cutoff is for your tier. That's a good reason to become a deferred member, that you're just waiting until you're eligible. Another good reason to become a deferred member is that if you have any thoughts about coming back to work and earning more service credit, that would be a good reason to become a deferred member because then you can earn more service credit later. Whereas if you go ahead and retire, you can come back if you decide to come back to work here, you come back as what they call a retired annuitant, which means that you have a lot of limits on how much work you can actually do for any of our 6 participating employers. So if you're going to come back to work at some point, or you are not sure whether you're going to, that's a good reason to become deferred. Another good reason to become deferred is if you're establishing reciprocity, because when you're establishing reciprocity, you are leaving your contributions on deposit with every one of those systems. So essentially you're doing option A and then B, you're becoming a deferred member and then doing reciprocity. So those are the three good reasons. The bad reason is that if you are already eligible to retire, but you're looking at that age factor percentage and you're thinking, okay, if I stop working now, I'm ready to stop working. I'm already eligible to retire. But if I retire in like 3 years, I'll achieve that age factor percentage 3 years from now, and I'll get that higher age factor percentage. So yes, that's correct. You will get a higher dollar amount in your retirement allowance should you do that, but you're missing out on 3 years worth of pension payments and you'll never catch up. If you sit down and do the calculation, you'll find that you'll never catch up from missing out on those payments. So if you're already eligible to retire and you're not going to establish reciprocity and you're not going to come back to work here, then you should just go ahead and retire. And you can do the estimates for yourself and you'll come to the same conclusion, I think. Okay. Okay, so the question is, can I explain what I mean by must retire from all systems on the same day? When you link systems together, let's say that you worked for Contra Costa County for 10 years and you work for Acera for 15 years and you have reciprocity. Okay, so then you're ready to retire. What you do is you fill out a retirement application for both systems because we both have separate retirement processes. And on both applications, they're going to ask you what your date of retirement is that you're choosing, and you write down the same day. And that's how you retire from both systems on the same day. And you must retire from both systems on the same day, or else reciprocity is broken and bad stuff happens. Challenging stuff happens. Okay, so now there's a question, is your sick leave bank applied to retirement? That is one of the benefits of option number 1, if you remember, working straight into retirement. So we're talking about career planning, working straight into retirement. We will convert your sick leave on a 2-to-1 basis to service credit if you go straight into retirement. If you spend any time as a deferred member, you just lose all your sick leave. Okay, and then there was a question from earlier, what are the benefits of deferring retirement? That question is kind of like what I was just saying about the good reasons to defer retirement, those 3 reasons. Those would be the reasons. Those would be kind of the benefits of deferring retirement, is that you can maintain your Acera membership and still like establish reciprocity or come back to work later, or wait until you're eligible to retire. Okay, so option C, we've done option A and B. Option C is a refund of employee contributions and interest. Okay, so in this scenario, you're saying, I don't want to be an Acera member anymore. Excuse me. I'm done working. I'm not going to retire. I don't want to be an Acera member anymore. I don't want to collect the lifetime retirement allowance or have access to any of the non-guaranteed health care benefits or any of the other stuff. Cancel my membership, give me my money back. That's taking a refund. Now, if you do that, you may lose up to a third of your money to taxes and penalties. The penalties come in if you are under a certain age and you're taking a lump sum payment refund. It's a penalty for taking early withdrawal from a retirement account. I don't remember what the age is. I think Gene Hilliard might know what the age is later when he presents. But you may lose a third of your money to taxes and penalties. Or you could roll over that money into a pre-tax retirement account, and then you wouldn't be subject to taxes and penalties at that time. Okay. Refunds take 45 days, maybe 60 days, maybe more. It takes time to process these. So it's not an instantaneous thing right after you stop working. So it's just something to remember. And you're waiving your right to all Acera benefits. Now, let me make a little pitch here for not doing this for two reasons. And there are things that I already told you. One is that if you are actually already eligible to retire or you're almost eligible and you just need to work a little more to get there, it really pays to do that. Because like I was telling you earlier, if you retire from Acera and draw that lifetime retirement allowance, you're already going to get a refund of your employee contributions in that first 3 to 5 years through those Acera retirement payments. And then you're going to get a bonus for the rest of your life. You're going to get retirement payments for the rest of your life that you can count on, which could be multiple times whatever contributions and interest you would have been able to take out of the system. The second reason is that if you don't know what to do with your money yet, like if you're thinking that, okay, I'm going to take a refund and I'm going to go like try my hand at the market and see if I can make more money than I can make at Acera. I mean, good luck. It's really risky. And like I was saying earlier, if you leave your money on deposit with Acera, we're going to keep paying interest, and we earn probably about 7% interest a year, which is pretty darn good. And if you look at the past 30 years, if you annualize it over the past 30 years, even in times of like major downturns, we average about 7% a year, and there's no risk. So try to find somewhere where you can earn 7% a year and there's no risk. So that's my little pitch for not taking a refund. But if you need the money and you need to go do something else with your life, it's definitely always an option. And nobody's gonna. I don't think anyone's gonna try to talk you out of it. It's your money and it's your decision to do. Okay. Last topic: making a retirement planning picture. So I'm kind of actually already encroaching on Gene Hilliard's time. So I'm going to talk about this for probably 10, 15 minutes. And then I'll turn it over to Gene to talk about the 457 plan. And these topics kind of go hand in hand. Okay, so you remember this slide that I showed you earlier. This is what your retirement income will look like after you retire. You're going to get an Acera monthly pension. You're going to get Social Security payments if you've paid into Social Security for enough years. And anything beyond that is your personal savings and investments. And financial planners will tell you that you are going to need to have 70 to 80% of whatever salary you were making while you were working. You're going to need that 70 to 80% of that in retirement in order to maintain your standard of living. Now, Gene is going to get up here and he's going to try to get you pointed at 100%. Okay, we're gonna talk about 70 to 80% now, and then Gene will tell you about getting to 100%. But how do you get pointed in this direction? Like, how do you even start? Okay, well, here's what you do. It's actually pretty easy. It's a kind of a step-by-step process. What you do is you get some estimates. You get an Acera estimate. You use the benefit estimator, the tools that we provide to get an estimate of Acera. And then you also use the Social Security tools to get estimates. So you go out to Acera's website, log in, use the benefit estimator, get an estimate, get out a scratch sheet of paper, write it down, and then also make note of what age you are in this scenario that you're doing. Okay, so you're thinking of like a retirement scenario. I'm going to retire at age 62 in this scenario. And so what do I need to do to get there? So you get that ACERA estimate for retiring at age 62. Okay, then you do the same thing with Social Security. They have an estimator for you. They already have your data in the Social Security database. You log in there and you'll end up with a page that looks like this. They'll show you 3 different retirement ages of what you can collect from the Social Security system. So we'll look at this one, age 62, since we're retiring at age 62 in this scenario, and it's about $1,700 a month, but you can go ahead and write them all down. Okay, now you've already filled in 2 parts of the equation. You've already looked into the future and you've already made a projection of those 2 factors in the equation. So all you have left to do is the savings and investment part to gauge if you're pointed in the 70 to 80% direction or not. So how do you do that? Well, you use technology. There's all of these retirement calculators out there on the web that you can try out, and they will get you pointed in that direction. So you can plug in your numbers and they'll tell you how much to save, basically, or whether you need to save or not. I'll actually show you the Vanguard calculator right now. I have a screenshot here, but I'll just switch over there, and Gene Hilliard will show you the Prudential Retirement Calculator when he gets there. But there's a bunch of different ones. You just try a bunch of different ones. Let me go to a new share here. Okay, so I'm on that same planning your future retirement income page. You go to members, planning your future retirement income. Scroll down. And this is actually a more detailed step-by-step process that I'm taking you through right now. So this one you could do at your leisure, but I'm basically taking you through the same steps. Here's a link out to the Vanguard calculator. So this is going to tell me how much more to save and whether I'm in that trajectory of getting pointed at 70 to 80% income replacement by the time I retire. So I'm going to put some numbers in here. In this scenario, I'm 30 years old, which I'm not, but I'm just going to do that scenario. And I'm going to plan to retire at age 62. Okay, let's say that I make $70,000 a year. And then it asks me how much I already saved per year. I can put in a number here and it will tell me how much of my income I'm saving, but I'm not going to do that. I'm going to leave that blank for now. Okay. But you can go ahead and do that if you already do save money every year. So you can go ahead and put that in. Okay. Then it's going to ask me how much I've already saved. Okay. Let's say it's 0. I haven't saved any money toward retirement yet. I'm brand new to this. I don't know anything about this. I'm trying this for the first time. Let's just leave it at 0 and see what happens. And it's totally okay. Now, this percentage is how much income replacement you're getting pointed at. So I told you that financial planners will say 70 to 80%. I'm going to be conservative and I'm going to say that you're going to need at least 80% of your working income in retirement. This number here, what annual return you can expect, this is going to be individual to you. I recommend a number between 2 and 7%, because 7% is still kind of a conservative amount of earnings you can earn if you put your money in a diversified portfolio in the market. But let's just say 6% for now to stay conservative. Now, 2% would be very low risk options. You can kind of always get 2%. So that's why I kind of say between 2 and 7% just to be conservative. Let's say 6%. And this is going to be dependent on whenever you're saving your additional money, where you're putting it and how you're diversifying your portfolio, which Gene will talk more about when he talks. Okay, now I need to do 2 more things. I need to put in my Social Security estimate that I got, which was about $1,700 per month, and my ACERA pension, which was about $2,200 per month. And I'm going to hit calculate. Okay, what you're seeing are 2 bar charts. This is how much you're going to need for retirement per month in monthly expenses. This is how much you're going to have based on the numbers you already put in. You can see there's a gap. Okay, what we need to do is we need to get this bar up to here. Now you can see that how much your pension benefit is already providing, is already getting you up there in this scenario. And you can see how much Social Security is already providing. So what you're going to need to do is fill in the gap with additional savings. So you can go back up here and you can actually add some savings. So let's see what happens if I save $600 per year. How far will that get me? Barely anything. Okay. So let me go more than that. Let me see what happens if I do $6,000, saving 8% of my annual income. Recalculating. Okay, I overshot it. So let's go down to, let's see, 4,500. Recalculating. Okay, now they're about even. So what it's telling me is that this part is the part that my pension payment is contributing to how much I'm going to need in expenses in retirement. This is telling me how much Social Security is contributing, and this is my additional savings. What it's telling me is that I'm going to need to save $4,500 a year in order to get pointed at that, in order to achieve 80% income replacement by the time I retire. It sounds like a lot of money every year, but if you divide that up over 26 pay periods, in this scenario, it's only $173 per pay period. So maybe you can find that money and set that aside in your 457B account, and you would be pointed in that direction of achieving 70 to 80% income replacement by the time you get there. I recommend doing the calculators periodically, maybe once a year, maybe once every 6 months, and then see if the amount that you're currently saving is getting you pointed there. And then by the time you get there, 10, 15, 20, 30 years later, you will have achieved 70 to 80% income replacement. Okay, so regarding where to actually save your money, so you're taking this extra money out of your paycheck to save it, you're probably going to want to save it somewhere that you can earn interest. And interest is money that you earn for loaning out your money to like companies, to government agencies, by buying government bonds. And if whatever endeavor that they are doing goes well, then they'll pay you some interest for that, you loaning them your money, basically. And earning interest can help you beat inflation, which is about 3% per year. And it helps you earn more through the power of compound interest. Compound interest accelerates your savings because you're earning a little bit of money on your money that you're investing. And then the next time around, you're earning money on that money that you earned. And then the next time around, you're earning money on that money on that money. And so if you look at a compound interest graph, it always looks like this. It accelerates the longer you leave your money subject to the power of compound interest. Now be cautious, because the higher the potential interest, the higher the financial risk. So the more opportunity you have for a higher return, usually that comes with more risk. And so it's up to you to assume the amount of risk you want on where to save your additional money. Some really good options are the 457B plan, which I'm about to turn it over to Gene Hilliard, and he can help you get you into a diversified portfolio that will get you some interest over the long term, but like really mitigate the risk that you're taking over the long term. And you can put in up to $20,500 per year. If you max that out and you want to save even more, there's a list of really low risk saving options. This is actually out on that same webpage when we go into detail about each one of these. Just do your research on anywhere that you're putting your money. There's so many places that explain places that you can put your money in simple terms, like NerdWallet and Investopedia. It's actually not as complicated as you might fear. So I recommend just, if you don't understand a term, just like type it in, or you don't understand what a high yield savings account is, type that in and NerdWallet will tell you. Okay, you can get more help through the deferred compensation program. If you start an account, you can talk to the free financial planners there anytime you want, as many times as you want. If you start an account in the First United Credit Union, they will also offer a free financial planning. You can hire a financial planner, but they often charge a lot of fees, so look very closely at the fees. And like I was telling you, that article I was just showing you is the expanded version of the process I just took you through. It's acera.org/planning, or you just click on um, the heading under members, and it's called Planning Your Future Retirement Income. Okay, so with that, I'm going to go ahead and turn it over to Jean Hilliard, who is the county's deferred compensation representative for the county's deferred compensation program, which you all have access as government employees to open deferred compensation accounts and save additional money. So this is like a really powerful tool that you all have access to. So Jean, are you there?
I am here. Thanks, Mike. Let me hit the share.
Jean, I can't quite hear you. Let me actually, it might be my speaker system. Hang on 1 second. Let me check my sound. Oh, yep.
Okay.
That's what it is.
Can you hear me? Okay. Can you hear me okay?
Now I can hear you.
Okay, perfect.
Okay, so yeah, let me stop my share and go ahead and feel free to share your.
You got it. All right, let me change the display settings here. Swap, here we go. All right, well, good morning. My name is Jean Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. We provide tax preparation, financial planning. We do accounting for small businesses. So it's an honor and it's a pleasure to meet with you folks today. A little bit about my background. I'm a licensed stockbroker, financial consultant. Been doing this work for roughly 19 years, helping my clients create wealth, maintain their wealth, and make sure that that wealth lasts throughout their lifetime and the lifetime of their children and grandchildren, if possible. I'm also a retirement counselor, and my goal as a retirement counselor is to help you folks maintain your current lifestyle in retirement. Right?
Hey, Jean, I'm not seeing your presentation.
You're not?
No.
That's not good. All right. Bear with me. Let's see.
Maybe I need to make you co-host.
I thought that you did that. Let me share screen again.
Okay, there we go. I'm seeing your note.
Now?
Yeah.
All right, let me do something else here. Swap. Can you see that?
There we go. That's it.
Okay. All right, perfect. Perfect. So as I was mentioning, my goal is to help each and every one of you maintain your current lifestyle in retirement. And what exactly does that mean? Mike talked about it earlier, and it is true. Most financial planners say you need roughly 70 to 80% of your pre-retirement income. I've often tried to challenge myself and challenge my clients to get to 100%. If we need to settle for 70 to 80, then that's fine. I mean, there's nothing wrong with having more in retirement versus less. So let's shoot for 100. And if we need to, we can settle for 80 or settle for 70, etc. And one of the best ways in which to make that happen in terms of maintaining your current lifestyle is using your deferred compensation plan. Okay. And I'm going to talk a little bit about that. It's not going to take very long. I'm sure you guys are probably a little winded from the presentation. It'll take roughly 30 minutes. But before I dive into the presentation, I just want to make sure that folks are aware, if you're currently in the plan, that Prudential Retirement sold their retirement business to Empower. So Empower is going to be the new third-party administrator. Empower is an excellent company. They're roughly the second largest third-party administrator in the country, right? So everything's going to pretty much stay the same, but a lot of the logos, et cetera, are going to be swapped out. You're going to see Empower. Okay, so I just want to make sure folks were aware of that. We haven't fully implemented everything. So when you look at my presentation, you're going to see Prudential, but probably in the next 6 months, the presentation will say Empower on it. Okay, so let's dive into it. You know, these are the areas we're going to discuss. We're going to talk about bridging the gap from ACERA, pension, and Social Security. We'll talk a little bit about automatic payroll deductions. tax deferred versus Roth, the investments, consolidating the plans, and the loan feature. But in terms of bridging the gap, right? Uh, and I talked about it earlier, how deferred comp can bridge that gap towards retirement. So you're going to have, you're going to have your ACERA, you're going to have your Social Security, and you may be short, right? And typically, financial planners, or at least the way I operate, is I tell people, write down your current salary, your current annual salary, right? Write that down. Then once you write down your current salary, subtract what you anticipate receiving from ACERA annually. And you can do that on the ACERA website. Use the calculator, play with the calculator. Say I want to retire at 62 or 65 or 55, whatever the case may be. It's going to tell you roughly what your pension is going to be. And if you're old enough to collect Social Security, if you're going to retire after 62, you can write that down. So subtract that out. So when you take your current salary minus ACERA, minus Social Security, that's going to leave you short. And that shortfall is what you want to use deferred comp to cover. So your shortfall is going to be X amount of dollars. Typically, you're going to need 20 times whatever that annual shortfall is, right? And if you need some help going through that calculation, I want you to reach out to me and I can help you with that. Well, let's talk about deferred comp and how easy it is. It's simple. Some people, the way in which they operate is they get paid, they pay their bills, and if there's money left over, they write a check to the investment company, right? How often is there any money left over? Even if there is money left over, it's probably in your mind, you're probably thinking, well, Johnny's going to need braces in 6 months, so I need to put some money aside. Or I'm going to need some extra money for vacation, so I better put that aside. And you don't have any money left over, right? But here with deferred comp, money comes directly out of your paycheck. Just like when you pay your taxes, right? How many of you would really save money in a savings account to pay your taxes later? That would be challenged. That's why when the government takes it from you when you get paid, it makes it a lot easier. Or if you're paying us, you pay your ACERA retirement benefits, premiums, etc. Life insurance, union dues, all of it comes directly out of your paycheck in a sense. So it makes it easy. So deferred comp is no different. So when you don't see it, you don't miss it, and you don't spend it. There are a couple of ways in which you can invest your money in deferred comp. Most people will invest their money pre-tax, right? That's where you get a tax write-off. It's almost like writing off mortgage interest or writing off the fact that you have children. It's a built-in tax loophole. So let's say hypothetically you make $70,000 working with the county. You decide you want to put $10,000 a year, or let's say $5,000 a year into deferred comp. Instead of being taxed on 70, you're taxed on 65. So it reduces your taxable income. You save in taxes. And if you're getting a refund now, there's a very good chance that your refund will be even bigger when you file your tax return. Or if you normally owe, but yet you put money into deferred comp pre-tax, that could potentially put you in a situation where you could break even and not have to owe. Check with your tax person to confirm that. I'm just giving you some scenarios and ideas where some people benefit by investing pre-tax. But going back to pre-tax, let's go back here. Going back to the pre-tax, keep in mind that when you invest pre-tax, it works best if you believe you're going to be in a lower tax bracket. So if you fast forward the clock to retirement and you think you're going to be in a lower tax bracket, the pre-tax option is probably the better option. But let's say, for example, you may find yourself in a higher tax bracket. Say you anticipate inheriting a bunch of property in retirement. So that could potentially push you into a higher tax bracket. Or maybe you have a spouse, domestic partner, significant other that works for a technology company that could go public, where you could instantly become a millionaire. Then that could potentially push you into a higher tax bracket. So maybe going the Roth version of deferred comp makes more sense, right? Or let's just say, quite simply, we live in a country where it appears that our debt as a country continues to go up and up and up, despite what political parties in power. And the fact of the matter is, if we continue to run these high deficits and we have all this debt, the government's going to have to raise taxes on everyone. So I want to get the taxes out of the way now, right? The Roth version of deferred comp may make sense. And that's where you're putting after-tax money into an account. So let's say over your career, you put $100,000 into deferred comp Roth, not a Roth IRA. It's a Roth 457 or a Roth deferred comp account. Okay, so you put that 100 in there, it grew to $500,000. That means you have a gain of $400,000 that's tax-free to you. Okay, so maybe the Roth option makes the most sense for you. Okay, here's an example of a participant that is 25 years old and they want to retire at age 65. So I encourage them to put away $300 a month. For the next 40 years, this person is looking at a balance of $575,000. So that's a pretty significant chunk of change that a person could use towards retirement. That will certainly probably get them closer to that 100%, right? But here's a person that, maybe they were hard-headed. They heard my presentation 10 years ago, but they decided against it. Or maybe they had student loans, maybe they weren't making a ton of money, but now they're ready to invest in deferred comp. They're 35, but because they delayed, there was a delay here. It's going to cost you. So I encourage them to put $500 a month into deferred comp. This person still wants to retire at 65. So that's the ideal retirement age. So for 30 years, you're looking at $490. But let's say you started with the county late, you're 45. Again, because you're older, it's going to cost you. So I encourage you to invest $1,000 a month. Still want to retire at age 65, you're looking at $455,000. Okay, so the point of this slide is obviously here, you want to start as soon as you can. As soon as you hit county services, you want to at least start putting $20 away or putting something away, right? This person at 25 was putting away 300. That's a pretty significant amount of money that they're going to have at age 65. So we want you to start early, but we also want to make the point that all is not lost if you do wait. Maybe you're 45, maybe you're 50 now, maybe you're 60 now, and you plan on retiring at 67. It's never too late. Just start putting away some money. It'll certainly change your retirement. I'm confident of that. Okay. Many folks have the option of investing in an IRA, individual retirement account. And here's the limits in 2022. You can put away 6,000 if you're under 50, 70,000 if you're 50, or 7,000 if you're 50 and over. But deferred comp allows you to put even more money away. So you can really supercharge your retirement by investing $20,500 if you're under 50 per year, or $27,000 a year if you're 50 and over. Okay, how much should you save? That's a moving target. It all depends. I typically tell folks, if you're unsure, hey, shoot for 10%. Make it easy. 10% of your salary, put that away. That may or may not get you there, but you can start there and we can adjust it if necessary as the years go by. But these are the questions you kind of want to ask yourself in terms of saving towards retirement, right? At what age do you plan on retiring, right? Typically, the younger you are, the further out your retirement may be, and that's possible. You want to ask yourself, how many dependents will you have when you retire? And I'm sure some of you are thinking, well, dependents, Gene, what are you talking about? My kids are grown, or they will be grown. I'm not going to have any dependents. But have you thought about the fact that some people have to take care of their grandkids? Have you thought about the fact that you may even have to take care of your spouse, domestic partner, significant other, upgrade the house to make it user-friendly for a person that maybe that's disabled? Where do you want to retire is another big one. Hey, if you want to stay in the Bay, it's going to cost you, versus maybe moving down south to Georgia or Texas, right? Where the cost of living is a is a little bit lower. So you have to kind of ask yourself. But I will tell folks, people come to me and say all the time that they're going to move down south when they retire. And I always ask them, well, do you have any grandkids yet? And most of them say, no, not yet. But I'm confident that if your grandkids are still going to be in the Bay, you're going to stay in the Bay. So prepare to put away a significant amount of money to live in the San Francisco Bay Area. Okay, investment options. There are 12 investment options in deferred comp. Okay, if you're not a risk taker, you're not interested in taking on any risk, you don't ever want to see your money go down in value, then you can invest in the Alameda County Stable Value Fund. Guaranteed investment pays roughly 1.6%. Not going to make a ton of money there, but at least have comfort in knowing that you're not going to lose any money, right? And I just want to make the point about that particular investment. There's folks that are spreading ignorance around the county and telling folks, hey, you don't want to invest in deferred comp, you could lose your money. But you guys have sat through this presentation, you know that's not necessarily true. You invest in the Alameda County Stable Value Fund, you won't lose any money. That's a guaranteed investment. The interest could change, but your principal will never change. Okay. All right. So you can invest in the Alameda County Stable Value Fund. If, for example, you're the type of person that cares about diversity, you want to invest in a company that cares about diversity or cares about the climate. I'm not saying that's a good or a bad investment. I'm just saying if that's important to you, there's an investment in deferred comp that is considered a socially responsible fund. You can invest in that fund. Or say, for example, you are confident about index funds. You like index funds because they're cheap, they're inexpensive, and you feel that I want to get the most bang for my buck by paying the least amount in fees, and I believe in index funds, similar to Vanguard. Well, there's investment options through the State Street family of funds where you can invest in index funds. They charge roughly 0.01% of your money. So that's almost free. But if you want to create a diversified portfolio using a number of different asset classes, such as small companies, medium companies, large companies, international, you want to invest in bonds, those investment options are available to you. So you can do your homework, take a look at the fund fact sheets that you can find on the website, do your homework and create your own portfolio, right? But most of you are not experts at the market, right? And maybe you need some help. These are some questions you kind of want to ask yourself before you make a decision of doing it yourself. Can you pick your own investments? Can you manage these investments to and through retirement? Do you have the time to research, to find the right funds at the right time? Right? I'm sure many of you is probably no, and no, right? So most of you are probably going to need some help. So I encourage you to take a look at Goalmaker. Goalmaker is an award-winning tool created by Prudential Retirement in conjunction with the county and Morningstar, where you tell us what your investor profile is. I'm conservative. I'm moderate. I'm aggressive. We have a risk tolerance questionnaire that you can take that can determine where you fall in terms of your risk tolerance. So give us that information. Tell us when you anticipate retiring. Hey, Gene, I want to retire at 62 or 65, 67, or maybe even 70, right? You give us that information, we'll create an investment portfolio that makes sense for you and your family. There's also an excellent tool that I really like with Goalmaker called automatic age adjustment. So as you get closer and closer to retirement, the account gets more and more conservative. Makes tons of sense because as you're getting closer to retirement, you don't have time to recoup any short-term losses. So we want to start putting some money aside that's kind of almost guaranteed. So that's Goalmaker. You can also visit me. You can meet with me on county time with permission of your supervisor. And I can ask you a variety of questions, and I can help you draft an investment strategy that makes sense for you and your family. Provide a little guidance towards your retirement strategy. So just reach out to me. That doesn't cost you anything. So you can either do it yourself You can use Goalmaker. You can visit with me and get my opinion. Okay.
Gene,
I'm
there's a question. Are there any pictures that I guess describe the options? I guess maybe are there any? I guess they're asking if there's any pictures in the slides.
No, there are no pictures in the slides of the investment options, but I would encourage, maybe I'll put those in there next time, but I would encourage you log on to prudential.com/retire wow. Prudential.com/retire wow. And once you get to the site, just click on investment options. When you click on investment options, you'll see the fun fact sheets that will give you some details regarding the investments.
Great, thanks.
You're welcome. All right, so I'm sure many of you have maybe come from a different agency, San Francisco County, San Mateo County, et cetera. You have, or you've worked in the for-profit where you have a 401k. You might want to consider rolling your money into deferred comp. Consider it, right? The county's plan has roughly 10,000 employees with over $1 billion in assets. And because of the size of the plan, the expenses are very, very low because of the size. It's just kind of how this country works. The more money you have, the more free breaks you get. So you might want to consider, it's a pretty easy process. You'll complete a rollover form. You'll contact your former employer, find out what they need, and then everything will happen behind the scenes. A check will be sent to you, made payable to Prudential Retirement or Empire Retirement. And then there's no tax consequences for that. So please don't hesitate, reach out to me and I can give you some tips or some ideas in terms of whether or not it truly makes sense to roll your money in, okay? But it can be done if you're interested. All right, a lot of talk these days about income inequality, right? Seems like the rich are getting richer and richer and richer, and we're running on a treadmill, not getting anywhere, right? Deferred comp offers you the opportunity to create wealth. How is that? Well, I can tell you this. Back in 2008, when we were dealing with the last recession, the last crisis regarding real estate, there were homes that were being foreclosed on. Pretty sad situation. Homes that were worth $500,000 in 2007 were worth $250,000 in 2008. The rich continue to get richer and richer and richer because they have cash at their disposal to take advantage of these types of opportunities. Many folks, just like you, use their deferred comp. They borrowed against deferred comp to buy real estate back then for 50 cents on the dollar. So could you imagine what sort of wealth they've created since then? A pretty significant amount, right? Now, I'm not wishing another recession. I'm not wishing another real estate crisis on us, but recessions, they do come every 4 to 6 years. Some are more painful than others. But I have to ask you, will you be ready if and when that next opportunity presents itself? Put some money in deferred comp to at least put you in a position to possibly take advantage of that. Okay. All right. So what's next? The next step is to, if you're not logged on or if you're not signed up for deferred comp, log on to prudential.com/retire wow. Prudential.com/retire wow. Click on enroll in the plan if you're not in the plan. And I would encourage you, once you start this process of signing up, don't stop because you'll get distracted and it'll be a year or 6 months before you remember you didn't sign up. So I want you to keep clicking until you get to the page where we ask for your signature. So when you're logging in, click on enroll in the plan. We're going to need your employee ID number, your name, email, etc. An email will be sent to you, right? One of the first questions we ask is beneficiaries. Who's going to inherit the money if something were to unexpectedly happen to you? Okay. Most folks don't have their social security numbers of their kids or their spouse handy, so they stop. I want you to keep moving. We don't need your social security numbers of your beneficiaries on the front end. We don't need it. We want it at some point, but that doesn't stop you from signing up. So put the person's name in, put the relationship, put their number, address, and keep it moving. The next area where folks get a little tripped up and they stop is on the investment piece. I'm not an expert in the market. I have no idea what I want to invest in. Let me make an appointment with Gene to confirm. I don't want you to do that. I want you to, for the time being, just sign up for Goalmaker with age adjustment. Just choose Goalmaker with age adjustment, keep it moving. Then you can circle back with me, schedule an appointment, and say, Gene, does Goalmaker make sense or should I do something different? That's just my opinion. Another option would be to just choose 100% Alameda County Stable Value Fund for the time being. The whole point here is we want to get you signed up as soon as possible because time is of the essence. The longer you wait, that's money you're probably leaving on the table. So get signed up. You're not alone in this retirement planning journey. There are a number of us within the county's plan that can help. It's myself in the middle. You have Mark Tomei with Wells Fargo Advisors. You have Jason Brummett with Prudential Retirement, now known as Empower Retirement. You can contact us at this number, 855-969-4572 to schedule an appointment. Right now, it's strictly virtual and phone. You can also log on to the Prudential site, prudential.com/retire-wow to schedule an appointment. If you want to bypass the 800 number, you can call my office directly. My office number is 510-562-6355. That's 510-562-6355. Make sure my assistant is aware that you are an Alameda County employee. That's code word for VIP, a very important person, and you'll get the first available appointment. Okay, so you get to skip the line. You can also email me if you prefer. My email address is g_Hilliard, HILLIARD, @emergefinancial.com. Okay, so with that, I'd love to entertain any questions. I kind of sped through this a little bit. I try to get this done before 12. So, but I think I covered the main points here. So love to entertain any questions you folks might have.
All right, I think at this point we'll end the video portion of it. So for all of those of you out there watching on video, thanks for spending this time with us. And we wish you a beautiful day and a beautiful career and retirement.